Hi, I'm Ankit from ValueNest Buyers Agency, and I specialize in research-led property investment strategies. I help property investors make confident, data-driven decisions by focusing on numbers and fundamentals, not just the headlines. In 2025, many markets outperformed forecasts, government incentives were introduced, and buyer pre-approvals hit record levels in the last quarter of 2025. What we are seeing now is the lag effect of those changes. So in this video, I'll break down 7 regional cities, show you exactly what the numbers are, and explain why these markets are building momentum going into 2026. So let's start with the bigger picture. What exactly happened in 2025? Actual growth exceeded predictions, government incentives were introduced, loan pre-approvals surged in the last quarter of 2025. At the same time, stock on market declined, vacancy rates fell, and inventories tightened. These forces do not impact the prices instantly. They work with a lag, and that lag is now pointing directly at early to mid 2026. So let's start with the first suburb, which is poised for growth. It's Geelong in Victoria. Now, Geelong is a vibrant regional city with a strong sense of community, a well-developed waterfront, and its proximity to Melbourne and the Surf Coast continues to attract families, professionals, and long-term renters. The city also benefits from strong infrastructure, quality schools, and healthcare facilities. Now, the demand in Geelong is further supported by Deakin University and expanding employment opportunities. Now, let's look at what the data looks like for Geelong on the charts. So, the first key change that we saw happened in Q4 2025, where stock on demand declined steadily in the last quarter in 2025, and now it sits at 0.33%. At the same time, vacancy rates show a steep decline since July 2025, falling to around 2%. So what does that mean in real terms? A stock level of 0.33% tells us that listings are extremely limited. A vacancy rate of 2% tells us rental demand is very strong in Geelong. Inventory levels are around 20 days, meaning if no new listings come on the market, stock would be absorbed in under 3 weeks. Days on market sits at 26 days, which confirms buyers are acting decisively but not irrationally. Rental yields are approximately 3.3%, which supports holding costs while the growth plays out. So numerically speaking, this is a very tight demand-led market heading into 2026. Now let's move on to the next suburb in our list, which is Ballarat. It is again in Victoria, a key regional area and center in the Victoria that continues to attract Melbourne commuters, families, and retirees. Now, one of the biggest drivers here is affordability, especially when it is compared to Melbourne. This has made Ballarat particularly attractive for first-home buyers and investors both. There has also been some ongoing infrastructure investments in transport, healthcare, and education. Now, from a data perspective, Ballarat is showing again very strong fundamentals. Now, Ballarat's numbers show one of the sharpest supply contractions in the group that we are discussing today. So let's talk about the real numbers. Stock on market fell from 0.45% in July 2025 to just 0.24% by December 2025. Inventory levels are extremely low, sitting at around 21 days. Days on market 31 days, and vacancy rates have dropped from 3% to just 1.5%. Now that is a 50% reduction in rental vacancies in under 6 months. What does this mean now? Fewer properties available to buy and fewer properties available to rent as well. Now when both tighten simultaneously, growth is usually demand driven and sustainable in the long term. This is something which gives us confidence for investing in Ballarat. Rental yields are sitting at a healthy 3.9%, which is good. Ballarat's affordability is now relative to Melbourne, and it amplifies its effect going into 2026. Now let's move on to the third suburb, which is again in Victoria. We have been talking about this suburb from last 12 months as well and has shown great momentum. So it is Bendigo. Bendigo is a very well-established regional city with a diverse local economy and very steady population growth. Bendigo is not at all a speculative market. It's a market which is supported by consistent demand and strong rental fundamentals. Bendigo's strength comes from data reliability. A sales volume here is around 162 sales per year, which means this is an active and liquid market. Stock on market is extremely low at 0.08%. Inventory levels sit around 21 days. Days on markets are approximately 25 days. Vacancy rates are very tight at 1.3%. Talking about the rental yields, which are high compared to any other Victoria market and sits around 4.1%. So again, numerically, Bendigo offers factors: low supply, strong rental demand, and enough transaction volumes to support stable price growth. This is typically how lower volatility growth markets behave, and that is the reason why we focus on Bendigo a lot, and we believe this momentum is going to carry on in 2026 as well. Now let's shift our focus to New South Wales. So first on our list is Maitland, which is one of the fastest growing regional areas in New South Wales. Maitland benefits from its proximity to Newcastle and the Hunter Valley, along with very strong transport connectivity. Maitland continues to attract families, first home buyers and investors. Population growth here is one of the key drivers for its growth. Now first, let's look at what happened in the last 12 months in this area. East Maitland grew by 9.9%. Areas like Rutherford grew by 9.1%, which is massive. So it means that demand was already present. Now let's look at what happened after the first home buyer incentives were implemented. In July 2025, the stock on market was around 0.60%, and by December 2025, it dropped to 0.15%. So that is a 75% reduction in stock in just 5 months. Inventory levels declined at the same time, now sitting at just 18 days. Days on market is 38 days. Vacancy rates are around 1.24%. Talking about rental yield, it is again healthy at 3.8%. So numerically, this tells us buyer demand surged once incentives were applied, interest rate cuts happened, and supply could not keep up. That kind of imbalance often supports multi-year momentum and not just a short spike. In New South Wales, which we will be talking about, is Dubbo. Dubbo is a major regional hub for Western New South Wales. It is supported by strong employment in education, health, and government services. Affordability continues to attract new residents and investors both. Dubbo's number confirms growth and conviction both. Median house prices here grew by 7.8% over the last 12 months. Sales volume sits at around 649 transactions per year, which is very high for a regional city. We have not seen anything like that in any other regional city. Stock on market is also very low at 0.16%. Inventory levels are extremely low at 18 days. Days on market sit around 31 days. When we talk about the vacancy rates, it's very low at 1.5%. Rental yields sit around 3.5%. Now, when price growth is supported by high turnover, it significantly increases confidence that the trend is sustainable. So these were the two suburbs which we think will be growing a lot in New South Wales. Now let's shift our focus to Queensland, which is one of my favorites, specifically because of the higher rental yields there. So first in our list is Townsville again. We have been speaking about Townsville from last few years, but once again Townsville has outperformed the market. It is a major regional center in the North Queensland. Townsville benefits from employment in defense, health, education, and resources. It also offers a strong coastal lifestyle which continues to attract the residents. And now from a growth perspective, several suburbs have recorded very strong price increases over the past year, especially areas in Northward where house prices grew around 34.6%, which is massive, and units performed a massive 23.2%. And areas like Kirwan showed a growth of 18.6%, which stands out. Most of here it is because of the lack of supply. Building approvals are extremely low here as well. Now let's look at what the current fundamentals in Townsville look like. First one is stock on market at 0.21%. Inventory levels are decent, 24 days. Days on market approximately 30 days. Vacancies around Townsville vary between 1.9% to 3%, and rental yields sit between 4 to 5.5%. Now the last suburb in our list is Toowoomba. Toowoomba is a major regional hub for the Darling Downs. It benefits from strong employment in health, education, and agriculture. There has also been significant infrastructure investment, including major transport projects. Affordability compared to Brisbane continues to drive demand. Capital growth over the past 12 months has been very strong. Areas like Centenary Heights showed up to 14.3% growth. South Toowoomba grew by 24.1%. When we talk about stock on market, it sits at 0.16%. Inventory levels around 24 days, and days on market sit at 40 days. Vacancy rates are approximately 1.27%. Rental yields around 4%, which is again very healthy, which we expect in Queensland. Now, when multiple suburbs grow at double-digit rates while supply remains tight, it usually signals ongoing demand and not exhaustion. Now, what did we derive from the analysis of these three suburbs? So when we look at all the charts, the numbers tell a consistent story. Stock has fallen in some areas by 50 to 75%. Vacancy rates have halved in most of the key markets. Inventory levels sit below 25 days almost everywhere. Now, these are the the conditions that historically support continuous growth. This is why we focus on data first. So if you would like to understand which of these markets best fits your strategies heading into 2026, feel free to reach out and start the conversation. Thank you for watching this video. See you in the next one.